Hey everybody, so I just wanted to go over the different types of accounts. I know we covered this a little bit in chapter 1, but this will give us just a slightly more in-depth look at the asset accounts, the liability accounts, and the equity accounts. So I will just jump right in and we'll start with asset accounts. And so remember, assets are things that a business owns, or things that it uses to do business. And so sometimes people think of human resources as assets, but you can't own people. And so asset accounts, people are not asset accounts. Anyway, that's just an important thing to recognize. Asset accounts include cash, which is what it sounds like, money that's available to use. Accounts receivable, which is money that is owed to us by our customers. When we sell things and allow people time to pay us, that creates an accounts receivable. Notes receivable is also money that is owed to us, but instead of it just being an informal relationship with customers where we say, hey, you can pay us in 30 days, notes receivable come about when we draw up an official loan note and agree to terms on how people will pay us the money they owe us. Prepaid accounts, they're a little bit confusing. When we pay something in advance, like we pay for our rent for the next year, or maybe our insurance we pay for the next year, that money doesn't just go away, and we can't really claim it all as an expense because we're going to be getting benefit for it for the next year. So instead, what we do is when we pay cash to purchase, to pay for, let's just use rent as an example, our rent for the next year, what we'll do is record that as an asset called prepaid rent. And then each month, when we get the benefit of using the building that we're renting, we will record that as a rent expense, and we'll reduce the amount of our asset, prepaid rent. And we'll see a little bit more about that in the future. Supplies, those are assets that we use in the day-to-day operating of our business, but that we typically assets that we consume or use up. And that's as opposed to equipment, which are assets that we use, but that last a long time, sometimes over years and years. Buildings are another type of asset, things we own for the long term, and land. That's just what it sounds like, land that we might build a building on. So those are the basic asset accounts. Of course, there's other types of assets, things like patents or trademarks. But these are the basic type that we'll deal with in the next chapters. Liability accounts, that's money that we owe. That includes accounts payable, money typically owed to our suppliers, typically in an informal way when the supplier says, hey, you can pay me anytime between now and the next 30 days. That creates an accounts payable, money that we owe the supplier. Notes payable are a more formal sort of relationship where we agree to borrow money from someone, and we again sign a note that explains how and when we'll pay that money back. Unearned revenue. This one's a little confusing because it has revenue in the name, so it doesn't sound like a liability, but it's unearned revenue. What that means is when someone pays us in advance for work we will do for them in the future, then we can't record it as revenue when we get paid because we haven't earned it yet. So instead, we record it as a liability called unearned revenue. And then in the future, as we earn that money, we'll record it then as a revenue, and we'll reduce that liability, unearned revenue. And then accrued liabilities are also a little confusing until you've worked with them. This just means money we owe to people, typically because of some sort of a debt we incur. The most common would be like salaries and wages payable, right? We only pay our employees on payday, which is usually every 2 weeks or twice a month, depending on the arrangement. And so as soon as the employee works, even if they just work for an hour, we owe them money, but we're not going to pay them until payday. So accrued liabilities are those things we owe people that kind of add up or accrue over time, and that and then we'll pay them off on payday and we won't owe them anymore. And so accrued liabilities, like I said, wages and salaries payable are probably the most common one. Finally, we have equity accounts, and equity accounts are, well, the first is owner capital. That means money that the owner has put into the business. And then revenues is money that the business has earned through operating. And then owner withdrawals will reduce the amount of equity we have. So this is money the owners pull out of the business to use for their own personal uses. And expenses, money that the business spends for its operating. So those are the different types of accounts. And like I said, there's others, but these are the main ones and the ones we'll see over the next several weeks.